So I've had loads of comments about, has the market bottomed out? Has it even crashed? Should I buy? Should I sell? I'm a first time buyer. Is it the right time to start thinking about buying a property? I want to become successful. I want to make money in property. What happens if I don't buy and prices start to go up? Well, this is how to build wealth in a housing market crash. What's up guys, Dan Trevini here. I hope you're all well. Before we get started, I need you all to do me a massive favor and smash the like button, and don't forget to hit subscribe. Whether you agree with me or not, if we're in a crash or the crash is coming or it's to come, or we're not at the bottom, or prices are going to start climbing, or there's not going to be a housing market dip or boom, if history has taught us anything, building wealth in a recession, in a housing market crash, is the best time to do it. So I'm going to give you my top 4 or 5 tips on how to build wealth in a UK market crash. Now, Warren Buffett, I'm a huge fan of his. One of his most famous quotes is, when the tide goes out is when you see who is swimming naked. And the property market is no different. When things get tough, you get to see who the true investors are, the true developers, the true entrepreneurial people within property, and underlining it, the true success behind everyone. In the last recession, just after the crash, I barely got out of it by the skin of my teeth. I made some big mistakes before the recession. Didn't help me ride the wave of the tough years to come. And because I didn't prepare myself, I couldn't take advantage of the opportunities that were staring at me in the face because I didn't have cash, I didn't have the experience, or lenders weren't lending. It was a mixture of all of them. But after fighting in the trenches for a few years, I did manage to find some little snippets and little nuggets which helped me trade my way out of debt and trade my way out of being in a negative position to be in a position where I could start investing more aggressively in property and building more of a portfolio and moving on to bigger things. Over the last couple of days, I've been thinking about what I did and what I learned in that time, which could help someone in this particular set of circumstances. Now, we know this recession is going to be different in many ways to the last, but in some other ways, it's going to be very similar. So some of the things that I'm going to tell you will work, but they need to evolve to be more relevant to today. So the first one, which is one of my favorites and is really relevant to all of the negativity and all of the comments of the masses about where we are, where the property market is, what you should be doing, what you shouldn't be doing, which goes against a lot of what I've said already in the video. This is why I really like those comments, because it brings me to my first point, which is react to the overreactions. What does that mean? In any market, in any business, the opportunities are born through the interpretation and the reactions to what's going on in the market. The market doesn't crash because of the coronavirus. The market crashes because of people's reactions, which includes lenders. When there are lenders overreacting and pulling from the market, which happened after the Brexit vote as well, or lenders dropping loan to values, and then people stop buying and people stop selling, this is all an overreaction to the influences to the market. And whether you agree with me or not that is an overreaction is irrelevant, because it's the action of the overreaction which is where we need to react. Now, if you've ever seen me present or you've watched previous videos, one of my biggest bits of advice is to make sure you're able to react to anything that can affect the market, good or bad. In 2015, when our friend George Osborne hit us twice, the stamp duty levy and then the interest rate relief was removed, that created a new set of circumstances to the market, and there was a lot of overreaction. One of my biggest years was selling to that market who were overreacting. People who were paying 8, 9, 10% more for properties to save an extra 3% stamp duty is a really good example. So make sure you start to look where people are overreacting and adjust. Now, don't just buy anything because you'll buy yourself into trouble. You need to work harder and smarter more than ever. But the deals are there. Notably, which brings me quite nicely onto my next point, and this is one of the things that really helped me sort of spike up in my journey in property, was understanding that wealth is not lost. Even if the market does drop by 5, 10, 15, 20, 30, 50, 90%, That will affect me and that will affect you and it will affect a lot of people. But I'm not going to overreact so someone can react to my overreaction. I need to understand what is happening to my wealth. Now, I wasn't earning a huge amount of money, I was in a huge amount of debt, and no matter how hard I worked, I couldn't get out of this cycle. And it wasn't working hard enough, I just wasn't working in the right way. And then I understood that money should be working for me, not the other way around. And then eventually I started to work with other people, so other people's money was working for me and them. And as I understood this thing about wealth, my attitude changed and my focus and my direction became about creating wealth. And with wealth over time comes cash. And it's not just cash, but it's more sustainable cash, less riskier, building a good foundation, which we'll come on to later on. So remember, even though prices are going to drop, that doesn't mean you have to write a check and give it to someone. The market will recover. Don't overreact. Keep hold of your property, keep hold of your stock, which brings me nicely on to the next point, which is building that wealth on solid foundations. Now, I respect and I appreciate everyone's set of circumstances are completely different. I know that there are certain entries into the property world where people take that route because of a lack of cash or a lack of experience or whatever it may be. But one of the biggest reasons I've never done deal sourcing and I've never done rent to renting is because I don't believe that they are good ways of building wealth on strong foundations. I'd much rather do a joint venture and earn less cash, but build more wealth. Eventually, after you do enough deals, you will be able to build some really solid foundations. And with solid foundations comes more security. More security makes finance easier to access. Easier access means cheaper finance. Cheaper finance means more profit. More profit means better wealth, higher growing wealth, easier growing wealth. So building wealth on strong foundations, which comes right back to owning the asset, whether it's completely owning it outright, owning it in a company, or owning it jointly with someone else, it doesn't matter. But it's always going to be better owning the asset than just taking control of it or selling a deal on for a quick buck. So with the strong foundations in mind, it kind of brings me on to my next point, which is targeting recession-proof investments. Even though I've branched off and done other things, I've stuck to some really key, simple principles, which is one, only invest in my own geographical location, but the main one is going to be your exposure and your market. Yes, cash does get eaten away over time, but the benefits of that cash being in the bank outweighs that negative by a country mile. The last point on recession-proofing your investments, the type of tenants that you're renting to. Even though I love the student market, I don't just rent to students because I don't like to keep all of my eggs in one basket. But recession-proofing your investment is not something that you will always consider when you're looking for these deals. Similar view to what you're targeting. And if that market fell off the edge of a cliff, what could you bring in that would give you a similar income or slightly less? Should the universities all close tomorrow, there is at least 2, if not 3 other markets where most of my portfolio could then go to. So even though we're labeling it recession-proofing, it's not actually recession-proofing, it's called smart investing. Thinking about Plan A, Plan B, Plan C, Market 1, Market 2, Market 3. So, recession-proofing your investments. And last but not least is my favourite, and it is becoming a leader of your own success. There is no reason why people can't become successful. Their biggest defeat is always going to be themselves. The best salesperson to yourself is you. In these tough markets, you can convince yourself not to do anything, and it's the right thing not to be buying, and it's the right thing not to be dealing. Step up and become a leader for your own success. There is no excuse. There is no one else who's going to do it for you, so you need to step up and be counted. And I've said it on so many other videos. Now is the time to buy. Now is the time to build your wealth. Building wealth in a recession isn't easy, but it is absolutely the best time to do it. That's it from me, guys. Hope you found the content rich. Don't forget to hit the like button and don't forget to hit subscribe. I'll catch you all on the next video.